Home equity agreements versus a HELOC. They might sound the same or similar, but there are crucial differences. So today, we'll talk about how do each of these financial tools work, what are the differences, which is better, and what situation it makes the most sense to use either tools. And so by the end of this video, I guarantee that you'll have more clarity when it comes to the differences between the two. And just for context, I've been teaching financial concepts and strategies for nearly a decade, invested millions in real estate as an investor, and I co-founded a financial services company serving all 50 states here in the United States. Oh, and stick around to the very end of this video because I do have a special gift for all of you watching to the end. So let's begin with simply talking about what a home equity agreement is versus a home equity line of credit. A home equity agreement is a relatively new concept, HEA for short. Now, an HEA is not a loan, unlike a HELOC. It's an agreement between you and a real estate investment company. They give you an X dollar amount in exchange for typically 5 to 15% of your home value. Essentially, the investment company becomes a co-owner of your home. So let's say, for example, your home is worth $500,000. The HEA company might offer you $50,000 cash in exchange for 10% ownership of your home. Since an HEA is not a loan, there is no interest cost and there's no monthly payments. However, when you choose to sell or refinance your home in the future, the HEA company also gets a cut and a share in the appreciation of your home. So let's go and use the same example to illustrate this. Let's say your home appreciates from $500,000 to $700,000. You now have a gain of $200,000. On the home equity agreement, you agreed that you'll give typically 25% of the gain on the appreciation. Therefore, the HEA company gets $50,000 from the gain, and they'll get their original $50,000 back for the 10% ownership of your home. Another really good way to understand this concept is to treat or think of your home as a business. The investment company buys a certain percentage of your business, quote unquote, with a promise for a share in the future profit. Makes sense, right? On the other hand, a HELOC is a form of a loan, and it does come with a monthly payment and interest cost depending on your withdrawal amount. And so here's how that typically works. So let's go and stick with the same example from earlier. Let's say your home is worth about $500,000 and you also have a mortgage balance of $300,000. That means you have a $200,000 worth of equity. Now, in most cases, the bank will lend you around 90% combined loan to value. What that means is that the bank will lend you an amount that is up to the 90% of the home value. But with a combined LTV, they'll also factor the existing mortgage to that calculation. So currently with the existing mortgage, you have a 60% LTV, loan to value. If the bank is lending you at 90% combined loan to value, that means they'll lend you an additional $150,000 in a form of a HELOC on top of the existing $300,000 mortgage you have. But unlike a mortgage, the banks may not require that you take the entire $150,000 up front. That's because a HELOC is a line of credit, kind of like a credit card. So they're essentially giving you a $150,000 limit in which you can draw all or parts of the $150,000 as cash. So at the end of the day, it's up to you on how much you like to draw, and depending on that amount, the line of credit will accrue interest based on the average daily balance. So both the HEA and a HELOC is a way to access your equity as cash. Both involves in repaying back the original amount plus some more either as interest or share in the profit. And both are lien against your property. But here's where the differences lie. How they're paid back is completely different. An HEA is paid back when you sell or refinance, whereas a HELOC has a monthly interest payment. Another difference is that a HELOC can be paid back, borrow again, pay back, and borrow again, as long as the HELOC account remains in the draw period. So in that scenario, a HELOC could give you more flexibility. With an HEA, you have to take the lump sum payment and amount without any short-term payment obligations. Okay, so now that we know how a HELOC and an HEA works and how they're different, let's go and talk about which option could be better for your unique situation. Now, my answer is, it depends. But what does it depend on? So first is the use case. What do you plan on using either an HEA or a HELOC on? Is it for remodeling, paying down debt, or is it to fund your children's education? So I'll go and share which tool might make sense the most for some of the most common situations. With remodeling projects, repairs, or you want that new bathroom you've always wanted, an HEA might make more sense if you're trying to avoid creating a monthly payment. Now, on the other hand, if you were to use a HELOC and borrow money for the renovation, it does incur a monthly payment, which cuts into your monthly cash flow. And that's cash flow for your future investments, paying down other debt, and etc. Plus, if the renovation could increase the value of the home, it's a win-win scenario for both you and the HEA company. Another scenario we can think about is paying off high interest debt. Now, in this scenario, I would actually side with using a HELOC for these types of scenarios. If you have credit cards that accrue 20, 25, or even 28% interest annually, paying them off with a lower interest rate HELOC at 6 to 9% might make a huge difference, especially if you don't have much of a wiggle room in your cash flow. So just by consolidating and paying off all the high interest credit cards could free up cash flow, and the same could be said for other types of high interest debt other than credit cards. But that's not all. There is a way of using a HELOC to paying off your mortgage faster. So I'll leave a link to a separate video in the video description down below so you can check it out after this video. Another common scenario is paying for educational expenses, whether it's for you or for your child. Now, when it comes to this, I'm kind of 50-50 on this one. Unless you planned ahead by having a separate savings account or investment account for educational expenses, both options as far as an HEA or a HELOC could work. Now, you might be suggesting student loan as an option, but as of early 2025, the student loan interest rates could vary around 6.5% to 9%, which is very comparable to a HELOC rate. So when it comes to calculating interest cost, getting a student loan versus a HELOC could be relatively the same, so a HELOC does stand as an option. Now, of course, the difference is that the student loan may come with some kind of a deferment to the payments each month, whereas the HELOC, you'll have monthly payments right away. Switching gears a little bit. With an HEA, this all depends on how much your home appreciates in the next 10 years. You see, here's the twist to how an HEA or HELOC could fit into your decision making. The twist is, look at the cost and the benefit analysis just from a financial point of view. It all hinges on how much your home could appreciate in the next 5, 10, or even 15 years when it comes to the decision making of HEA versus a HELOC. Okay, so check this out. This is a comparison tool that I built on Microsoft Excel to compare how much money we're having to give back at the end of the term for both an HEA or an HELOC, a home equity line of credit. So let's go and first look at the HEA option. And as you can see, I try to make the parameters relatively the same so that we're comparing apples to apples. So on the left, HEA option, home value, $500,000, just like my earlier example. And we're getting $50,000 from the agreement, exchange for 10% of the home value equity. Next, we're going to assume that our home is going to appreciate 5% across the next 10 years. Now, I get that it's not going to be 5% consistently every single year. On certain years, we might have 3% or even 7%. It's going to go up and down, but from a long-term perspective, it's going to average around 5%, let's say. So 5% appreciation across the next 10 years. Let's say the home equity agreement company is going to take 25% of the profit share, meaning the gain on the appreciation. So down below, your future home value assumption on a 5% appreciation across 10 years is $814,447.31. That means if we're giving away 25% of the gains that we got in the 10 years, we're giving away $78,611 to the HEA company. And additionally, we have to give back the $50,000 we got as part of the original home equity agreement. So in total, we're giving back $128,611 back to the HEA company. Now compare that to the HELOC option, which is a formal loan, where let's say we're borrowing $50,000 from our home equity with an interest rate of 8% across the next 10 years. And if we don't make any single principal payment, we just let the interest stack over time, okay? That means our interest cost is $57,946.25 in the 10-year period, which means given the principal and the interest that we're paying back, the entire total payment back to the lender is $107,946.25. Interesting comparison. So in this parameter, in this assumption, you can see that the HEA option is technically, quote unquote, the more expensive option, meaning we're paying back more to the HEA company versus had we gotten a HELOC, borrowed money at 8%. So what's interesting about this is that sure, our annual appreciation is only 5%. You know, it seems like it's a cheaper option compared to the interest rate, but the key thing to this is how much profit is the HEA company taking away from the gain? That's the question. And if our appreciation is, let's say, even more aggressive at 8% every single year, check this out. I mean, it's almost nearly double that the HEA company is taking. The The HEA company is going to get $194,000 in total, plus the $50,000 that they've given you, and they have to recoup that. So my conclusion is that in a highly appreciating environment on your home, it's probably better to take the HELOC option versus an HEA option, especially if you're thinking about the long-term cash outlay that you're having to get back in the 10-year period. So interesting comparison. Now, just the mere fact that an HEA company is making an offer is a hint that your home is likely going to appreciate even at 5% in the next 5, 10, or 20 years. Because based on the comparison I gave you, notice that an HEA might cost you more in the long run when compared to a HELOC, even at a high 8% interest rate. Another thing to think about is that these HEA companies have a dedicated research professionals that research the markets, figure out which homes and neighborhoods will likely appreciate, and many times they are selectively available in those types of markets that have higher appreciation potential, meaning that a company may not offer an HEA in certain neighborhoods or markets that are not likely going to appreciate. Because after all, they're in it for the profit as well. Wouldn't it be better for them to just concentrate and focus on the markets that are going to likely appreciate in the next 5, 10, 20 years? So one has to assume that if you are getting an offer from an HEA company, they probably know something that most of us don't. So here's the ultimate special gift that I promised in the beginning of the video. I'm gonna give you guys the calculator, the spreadsheet that I showed you earlier for absolutely free. There's no opt-in, there's no registration required, so feel free to play around with the numbers to create different scenarios for your unique situation. If you like this video, then definitely consider subscribing because we're releasing a ton of valuable content on investing, financial strategies for paying off debt, and much more. And soon we're actually coming out with a free course on real estate investing. So if you've always wanted to invest in real estate and grow your wealth and your income, we have a free course for you. So definitely subscribe and stay tuned for the next video.